A year ago, South Africa was a net loser in the currency wars as the quantitative easing undertaken in the developed world saw their currencies depreciate and in so doing made their exports more competitive. A year on, and the rand is now trading at 10 rand to the dollar, South Africa now appears to be winning the currency wars. So has the depreciation of the rand been a good or bad thing for the country? Chris Hart joins us in studio to share his views. Chris, great to have you with us.
No, thank you.
Net, win or loss for
Lose.
South Africa Inc.?
Yeah, lose.
Why?
Because we need to appreciate that there's two sides one needs to consider. One is what I call the income statement, the trading side, which apparently makes exports look a little bit more competitive, etc. But on the other side is your balance sheet side, in other words, the store of value side, and that's where we lost. And that's why, in a sense, we've got to be very careful that a weak rand often just translates into inflation, and that the growth that you're looking for, which actually comes from the balance sheet, the ability to buy capital equipment, the ability to do that, actually is diminished. And we're already a capital deficient country, and the weak rand has actually diminished our capital stock. Okay, and that needs to be, you know, that's why there's the irony is that countries that are wealthy and prosperous did so not on weak currencies but on strong currencies, and your wealthy countries have what we call hard currencies. Okay, and your poorer countries in the world have weak currencies or soft currencies, and that's something that always needs to be appreciated. Is that when you've got a weak currency, you also don't focus on the things that actually genuinely drive competitiveness, which is in fact your productivity gains, etc. So South Africa lags in productivity stakes because we've always relied on a weaker currency, and we've had, you know, it's always a case of, do we learn the lessons we experience? Because sometimes you experience a lesson and you learn it, and sometimes you experience a lesson and you don't learn it. And 3 decades of currency weakness, we haven't created jobs, we haven't really grown the economy, we've struggled to actually gain traction on GDP per capita, for instance, and that's with a weak currency. So where are all the supposedly the dividends that's supposed to stem from a weak currency? It's just not there.
But Chris, I have to take you up on this because we didn't run our banking system off the road, and we didn't have to go and print enough money.
No, exactly.
So the argument is, if we're the flip side to the US dollar, then why is it that because now that they've gone through a process of quantitative easing and essentially weakened their currency by doing that, now it's our problem. We talk about this manufacturing base being hollowed out.
The rand's not weakening because we quantitatively ease. We didn't do that, clearly, but what's happened is that there's a few inflection points that we need to appreciate. Is that one, we've got an economy that's got many inherent strengths, but there isn't a lifeblood in it. It's the pulse is actually weaker. We've got a current account deficit to weep over and a budget deficit, in other words, a twin deficit problem, which traditionally is, you know, when you look at emerging markets, is associated with risk, and that's with the credit rating downgrade then hanging over our heads, and that current account deficit needs to close, for instance, and it's not because the rand is overvalued or anything like that. It's just that you can't strike your way to prosperity. You can't, you know, we are struggling with commodity prices that are coming down, and we lack endogenous growth drivers within the country, and we need to actually re-establish that because we don't have the savings to drive the investment inward. So we need to depend on external investors. That places ultimately longer term pressure on the current account as such. And so it's not something that's, I think, fully desirable, if you like. We need to actually bring some of those endogenous drivers, and that's why, in a sense, you know, when the Treasury announced their tax review, and that I think it'll be great, but we need to actually look at it to say, how can we restructure our taxes so they are simpler, so that people who invest here, we're not a tax-free or tax haven, etc., but if you come and do business here, our tax laws have to be simpler than the US or France or whatever the case is. In other words, you become a haven from complexity. You also say, on the savings and investment side, you get, how can you say, that's where you can avoid tax. On the consumption side, you're going to actually incur tax so that you're not taxing the seeds, the capital formation. That is something that's critical because we have a context of an enormous unemployment problem. That's actually the national emergency, and so that has to take your policy priority, and then everything else has to be subordinate to that priority. We don't know how to prioritize policy here. We're trying to solve all the problems at once without prioritizing, and then you don't connect the dots. You say, when you've got this in place, you're going to actually damage job creation. When you've got this in place, you're going to damage job creation.
Okay, so we've got, and I know simplifying the tax base has been a big ticket item for every US president through every election cycle. But let's leave that alone for a second.
Yes.
In terms of the currency wars, this self-titled currency wars,
yes,
the Germans seem to have benefited from it. Who are going to be the winners and the losers going forward?
It's difficult to say because the currency war has actually become quite intense. Okay, and so the Japanese raised the ante, earlier this year. The South Africans, the rand is sort of won almost by default, not because that we're actually misbehaving on a monetary front at all, but it's just that we've developed these imbalances, the structural nature of this current account deficit rather than a deficit being more in the cyclical sense, and that's one of the things that I think is worrying why we're looking at an adjustment in the currency. But ultimately I think the currency will stabilize and will actually then drift a little bit stronger. I don't believe, what's happening there is that the concept of a hard currency is starting to actually be eroded in any case. So as I say, who wins the currency war? Well, who debases their currency the most, as it were, over time, and who is trapped the deepest in this? Because I think these central banks have been trapped. We see this with the Fed now struggling with just to taper, and we can see a negative market reaction. And so it's going to be interesting to see how it pans out. But effectively, what's happening is that you actually, the West, the US, France, and these countries are actually have shifted into what I call a debt Ponzi scheme. The system has become Ponzi because the debt that's being created is of a consumption nature, and you need more and more of it. And this is why we need to shift, from a South African point of view, away from this credit-driven, consumption-based growth onto a savings-based, investment-driven growth. Rather, it's absolutely critical because in South Africa's case, it's not the economy that exists that's the problem. It's the economy that needs to come into existence to solve our problems, and that's what we need to be focusing on.
We've got, I think the rand depreciation gave a jolt to South African investors, and I know many people have been begging South Africans to take their rands offshore when it was R6.50 and 7 to the dollar. But now people are thinking about taking money offshore.
Now you're
which currencies should they avoid?
Everything else, because you now have got a rand that is undervalued. All right. So why are you buying assets with an undervalued currency? One needs to, you're hedging your bets, as it were. When you hedge your bets, it's at a time when you feel it's not necessary. In other words, when the rand is at 6 and 7, you say, okay, let's hedge it because it seems to be stable and you don't need to worry. You don't start hedging your bets when the rand has actually already depreciated. That's actually silly. All right, and that's the point, is that the investors that hedged decided to react to rand weakness in 2001 when the rand blew out at that stage, did extremely badly, because at that stage you should be investing into South Africa, and the rand's getting to the point where you should be investing into South Africa. I don't think we've seen the last of the weakness, but from a point of view, if you talk about long-term valuations and you say, right, in 2 years' time, I would expect the rand to be closer to 9 to the dollar. But in the short term, and even in the next month, it still could pop up to the 11, 12, whatever. Pick a number. But the point is, ultimately, this is a level that you'll be buying into South Africa, not investing out of South Africa.
So what is the golden number for people to take their money offshore then?
Sure. I would say if it dips below 9, then you start to look again. That's the kind. One's got to be very careful of reacting. All right. Offshore investment is about long-term anticipating. It's a hedge because most of your stuff's onshore. You want your onshore investments to perform better than your offshore investments. But should things go badly, and they do from time to time, you'd say, I've got something offshore that'll carry me through that bad period. And that's what's happened. People who actually put money offshore in 2 years ago, etc., now are in a better position. They now can say, let's start buying cheap assets back into South Africa because our offshore assets have done well.
You recently returned from a trip to India with Glenn.
Yes.
At Investment Solutions. We had Costa Viennes on the show I think last year, and he was the author of some very interesting research about making the case for some currencies as an asset class on their own. So buying some of the
yes.
Some of the emerging market currencies with strong fiscal positions, good economic growth prospects.
Yes.
What do you say to that?
I certainly think that one needs to look at the opportunity set. And the opportunity set isn't the obvious. Because if we just, again, hindsight's always a wonderful thing. But to my mind, it's the BRICS, as a concept, to my mind, it's not something that'll go away. I think it's got, you're seeing generational shifts and it'll come back, etc. But to a large sense, that sun is setting at this stage, and the sun that's actually already in the midday sky is the second tier emerging markets, your Thailand and Indonesia and Colombia and Turkey and that kind of thing. That's basically where the engine of growth, and your frontier markets in not Africa as a whole, but very specific countries in Africa, that's actually now also starting on that, how could you say, where other emerging markets were 20 years ago, they're on that threshold and are actually probably going to actually see that generational shift from poor to lower middle income to middle income countries, over the next 5-10 years. And that's where the opportunities are, but it's not necessarily in equities. It could well be in what you were talking about previously, property or bonds or whatever that one's got, and it could be private equity. It's not going to be necessarily the traditional investment mechanisms and channels.
Great.